What is absolute return? Stock markets are volatile, and sometimes we have experienced extreme movements. Levels of correlation between different asset classes, equities, bonds, property, etc., have diminished in recent years due to unusual market conditions. And in addition, the low interest rates offered by banks and building societies on cash deposits are doing little to whet one's appetite for gains. Enter absolute return funds. Funds designed to target a positive return, which is generally uncorrelated to the market. These are different to traditional relative return funds, where the main aim is to outperform a particular benchmark or index, such as the FTSE All-Share, for example. Let's look at an example. If markets rise, a relative return strategy will want to beat its benchmark, but an absolute return fund will achieve its objective even if it underperforms the benchmark but generates a positive return. On the other hand, if markets are falling, the relative return strategy will have met its target by simply falling less than the market. It has still outperformed on a relative basis. But an absolute return fund would still have to generate a positive return, however small, in order to meet its investment objectives. This was seen across the board during the awful market conditions of 2008 and 2009, during the fallout of the credit crunch. Typically, traditional long-only funds will rise or fall in value based on the market movement. In essence, long-only means that you buy a stock with the expectation that the price will rise. The flip side is to short a stock. Buy it with the expectation that the price will fall, but still make you a profit. So, in order to achieve positive returns regardless of market conditions, absolute return funds have to take a slightly different approach. The use of financial instruments, known as derivatives, can allow a fund manager to make money whether the market is going up or down. Due to their more complex nature, these instruments bring with them different risks, and it's important to know these are fully understood before getting involved. By having different objectives to relative return strategies, absolute return funds therefore tend to have a lower correlation to other asset classes. They behave differently. This acts as a diversifier within an overall investment portfolio. This diversification can be particularly beneficial in periods of negative returns. Unlike the traditional relative funds, absolute return funds are not managed to keep in line with a particular index, for example, the FTSE All-Share. In not having to stick to a particular index, absolute return fund managers can enjoy greater flexibility in terms of choosing the companies in which they invest. They are not limited to those within a particular index and can fish in a number of different pools. It also means that they are not forced to hold a particular stock simply because it makes up a large proportion of the index, for example. As with any types of investments, absolute return funds carry risks. Investors should never lose sight of the fact that an absolute return is an aim, not a promise, and they come with no guarantees attached. Most absolute return funds can draw on a number of strategies and tools to enable them to deliver a positive return, which is generally uncorrelated to the market. But these are only as good as the fund manager using them. All absolute return funds vary in their individual objectives, which means the level of risk you can expect can differ dramatically. For example, a CPI plus 1% target will need to take on less risk to achieve its return than, say, a fund targeting an annual 10 to 12% return. You need to ensure you fully understand the objective before entering into any type of investment and acknowledge the risks that come with doing so. Remember, absolute return funds tend to lag behind both the market and traditional relative return funds during periods of strong performance. However, their ability to still deliver a return in a period of poor market performance counters this. Again, it's about taking the longer-term view. Preserving investors' capital is a key aim for absolute return funds, so it's important to find a fund manager with the talent and experience to do just that. It's the job of your financial advisor to help you find a manager whose style and approach suits you. Ideally, someone whose track record is proven in running both relative and absolute return portfolios. As more and more absolute return funds with increasingly differing strategies come to market, it is important that people fully understand what they are investing in. One size certainly does not fit all, and there may be hidden complexities. A financial advisor will be able to help guide investors as to the most suitable investment, as well as fully explaining all the implications. For help finding a financial advisor, go to unbiased.co.uk.